Get ready for more valuable financial insights from Northern California's premier retirement income planners, Ahmad and Jim Files, owners of Peak Financial Freedom Group. For more information, go to peakfin.com. And now, here's Dan and Jim.
Welcome to the Peak Financial Freedom Hour with Dan, Ahmad and Jim Files. We'd like to thank all the loyal listeners that tune in every week. A lot of you are currently our clients and you listen for any updates, and just to validate and verify what you've done has put you on the path for retirement success. And I think it just makes our current clients feel comfortable. Then there's a lot of people who aren't our clients yet, and they listen to us for a year, 2 years, 3 years, 4 years, 5 years, and then they actually call in and say, hey, I do need help because when I started listening, I wasn't in that retirement mode, but now I'm definitely in that retirement mode. I need your guys' help. I just had clients come in last week, and they basically told me they listened to us for 5 years, and now they're getting ready to retire, and they now feel like they need help, and they're in a position where what we do can significantly increase their chances of retirement success. So it's kind of cool. They've listened to us for 5 years. They know everything we stand for. They know everything we talk about. They know what we're going to do as far as put a written plan together for them to reduce risk, to create income that's guaranteed, that won't run out, and to make sure that their taxes are going to be managed and their fees are going to be managed throughout retirement. So it's kind of cool to see that. And we know people call in when they're ready. So if you are ready to get a free consultation and to have a free retirement income plan designed for you with no obligation and no cost, simply dial pound 250 on your cell phone and say the keyword money. That's pound 250, say the keyword money. Everyone needs one of these. Call in, we can then put this together, and then you can decide at some point in the future, do you want to become our client or not? And it's okay. We won't be mad at you if you don't become our client.
And the beauty about this is that there is no pressure. There is no obligation. We'll never ask you to buy anything ever, ever, ever. We will develop a plan for you, an income plan, a tax plan, a legacy plan. We'll show you how much after-tax income you need every month and every year for the rest of your life. We'll include inflation in that plan to make sure your budget is going up appropriately to maintain inflation. We'll show you how much you potentially can leave to your beneficiaries without after you use your income in your lifetime. We'll tell you whether or not the income will run out. Will it go up? Will it go down? We'll be able to look at any shortfalls in advance. We can tell you at year 27, you're going to be short $1,100. We can tell you that data based on our software. So come in, we can show you this. We can give it to you. We actually deliver the plan. You don't have to do business with us. We deliver the plan to you. Now, people say, well, why would you do that? Why would you spend all this time developing a plan, putting together an income plan, a tax plan, a legacy plan, putting all this stuff together for you, meeting with us multiple times, and not require us to do business with you? We don't require you, but we know we keep really good data here. If we can show you things that you've never been able to see before, if we can lower your stress, if we can stop you worrying about your money, if we can show you how to get to retirement successfully, there's a pretty good chance you might do business with us. So no pressure, but you're going to be fully educated on your money if you come in and see us.
Well, I think that's a great lead into some of the topics we're going to talk about today, Jim. And I want to start with a concept we call going against the grain. And what this means is that, when you look at what we write, when you look at our website, you look at our workshop, you listen to this radio show, you watch our TV show, you're going to see that you and I really go against the grain of the traditional financial industry. It's not because we disagree with the traditional financial industry. It's that we just don't think you've been told about the 2 stages of money in retirement planning. And the first stage is what you're probably under right now, which is called stage 1, asset accumulation. It's while you're working, you learn to invest fairly aggressively. You're okay with volatility and losses. You're making a salary. You don't need income from your assets. You're okay with the ups and downs, and you're going to use your money at some far distant point in the future. You're investing each month. So even if the market goes down, you're buying it cheaper, and that's okay then. But that's stage 1. What you haven't been told is that there's a stage 2. Intuitively, there's a stage 2 when you retire, but what in the heck are you supposed to do once you retire? Well, you have to reduce your risk significantly. You have to use your assets to create income because we have to replace your paychecks, and we have to make sure that your income is not going to run out for as long as you live. And we go against the grain because we're one of the few companies out there we know that says, hey, you need to transition into stage 2. And it's exactly what you're thinking anyway. We just give you the roadmap to be able to do so. And we might look completely different than other firms And it's not because we aren't in the financial business. We are in the financial business. We just only work with retirees and soon to be retirees, Jim. So our market is completely different than other people who will take all clients on. We just work with retirees and soon to be retirees.
And if you want to know whether or not we are a prospect for you to meet with, ask yourself, are you getting ready to retire, or are you retired? Are you worried about where your income's going to come from? Are you worried about the market? Are you looking at your iPhone or your personal device every day to determine, is the market up, is it down? Are you concerned about that? Are you thinking about how long you're going to live in retirement? Will you have enough money? Are you thinking about the things that you want to do in retirement? Are you thinking about the trips you want to take? Are you worried about your grandkids' education? Are you worried about these things? If you are, you're a perfect prospect, right? That is what we deal with every single day. People that are worried about their money and they don't have a plan in place. And our job is that we can't stop you from worrying. If you're a big time worrier, we can reduce your worrying, and sometimes we can stop a lot of people's worrying, but most people will still worry a little bit because, you know, the world's uncertain. But what we want to do is substantially reduce the worries about your money. And the only way that we can do that is to fully educate you on how planning should be done. And we have to put a plan in place. We have to put it in writing. In the end, Dan and I sign off on all the plans. And why don't people sign off on plans, Dan? Why don't other firms do what we do? And by the way, we have a long-term contract with a firm that manages thousands upon thousands of financial advisors. And they're recruiting these advisors from different financial institutions. And they're using our platform, what we use in our daily life every day with our clients, building plans to recruit these advisors. And now, why are they doing it? Because we're doing something that we believe is substantially different than most every other people. And this very large firm, Dan, actually uses our platform to recruit advisors to them so we can train them on this.
Well, one of the big reasons why other advisors don't do what we do is the amount of work that is required to create a full written plan that includes what we call a golden retirement budget. So we know exactly how much money you're going to need at retirement. That includes a retirement income projection that'll show where your income is going to come from every year for as long as you live from the different income sources. That will show how much tax you're going to pay. And most firms can't do that because they don't have the tax base or knowledge or certifications. I'm an accredited tax advisor. I was an enrolled agent with the IRS for 30 years, so we can do tax planning. Most of these other advisors are never, ever, ever going to put in writing the fees you're paying. We're going to put all the fees you see and the fees you don't see. They rarely will then show you how much income on a net after-tax basis you're going to have. They very rarely will show you accurately how much money can be potentially passed on down the road. And they very rarely, if ever, will show you how much risk you're taking and how you can reduce that. They are always typically trying to sell you something such as just assets under management, or let me manage your portfolio. Let's put it all into these stocks. Another reason is they don't necessarily have the experience and the ability to be able to create a full retirement income plan that takes a lot of years. We find an advisor typically needs 3 to 5 years of hardcore training to become really, really good at it. So those are some of the reasons why you won't have a plan right now. About the worry side, I came with and met with a client 3 weeks ago, and it's the husband and the wife, and the wife is the head of one of the largest tax divisions of one of the largest CPA firms that you would know in the United States. And very, very, very knowledgeable. But she is so flippin' worried about her money. I mean, completely. I'd say the first time I met her, she said it like 50 times. And her husband kept nodding. And he'd point to her. She is. And I basically made a bold statement. I said, okay, if you're willing to go through the process with us and just go through it, you don't have to become our client, but I guarantee if you go through the process, it will significantly decrease how much you worry about your money, not because you become our client, but because you'll know more about your money. And the husband said, I don't think she'll worry less. And I go, I will guarantee she'll worry less once we go through the plan. And he said again, I don't think she'll worry less. And I looked at her and I said, what do you think? She goes, I hope I can worry less. So we met with them a couple of times. And the third meeting, we presented, as we will typically do, a draft plan. And a draft plan is simply going to show, here's what our first crack at designing your retirement income plan can look like. And usually we make all kinds of changes to it. But I went through the draft plan that showed how we're going to reduce their risk by about 90%, how we're going to reduce their fees a little bit. They were already paying really good fees, so the fees will go down, but not significantly. Then I showed them how we're going to create an income plan that will give them, after taxes, $5,000 more to spend than they need every month. And they can retire in 2 years versus having to work 5 more years. after I went through the plan, I looked at him and he's nodding his head. I looked at her and she said, "Oh my gosh," she goes, "I feel so much better. Just knowing this information, I feel so much better." I go, "Are you worrying as much now?" She goes, "No, this shows me that we've been successful in accumulating the assets we need to have a successful retirement." Then I looked at the husband and he was nodding his head. He just couldn't believe that she actually has less worry simply because of going through that process.
And this is a very sophisticated person, very intelligent, understands taxes beyond probably any listener on this radio show today. And she was worried about her money. And I can see why people are worried about their money, Dan. We have lots of things around the world that should be worrying us. And if you just have your money in the stock market and hope it's going to work out, yeah, it might work out. And I hope it does work out for you. But you will continue to worry about your money unless you have a full plan in place. And as you mentioned, Dan, an income plan, a tax plan, a legacy plan, how much income you need after tax each month and each year for the rest of your life to make sure you maintain your budget. How much is income's coming off each income source? Is it guaranteed or not guaranteed? All those things you need to understand. It has to be put together for you. And when you see this, it's not confusing. It's not complicated. It's just math. But when you see the math, and math doesn't lie, you will feel more comfortable with your retirement.
You're back with Dan Ahmad and Jim Files, and we are in the Peak Financial Freedom Hour radio show. Today, we're talking about the concept of going against the grain, because it's what our firm does. Jim and I, we go against the grain of the traditional financial advisor, simply because most advisors work in helping you accumulate assets, taking the risk to grow them at the highest level, and knowing you could lose a lot of money on that ride, but being in it for the long run allows you that potential higher growth opportunity. We only work with retirees and soon-to-be retirees, so our advice is always going to be pointed at someone who is in retirement or within 5 years of retirement. If you're not in that crowd, don't listen to us. If you're in retirement or within 5 years of retirement, then everything we say is unbelievably pertinent to you. And there are really four main topics that we hit on when we talk about going against the grain, and we'll talk about this over the remainder of the show. The first one is, what is the appropriate amount of risk for a retiree or pre-retiree that we work with? The second one is, should you hang in there and ride out all stock market ups and downs regardless of how volatile the market is? Third one is the use of certain assets to create income that's guaranteed for as long as you live and protect the assets against losses in the market? Should those be things people should consider? And that would be in the form of some form of an annuity. And the fourth one is it important to have a written plan, or should you just rely on your advisor's promises verbally that says, "Oh, don't worry, everything will be okay"? So all four of those things are what we go against the grain, because right now, let's start with risk. Number one, what's the appropriate amount of risk for a retiree, pre-retiree? Well, if you go by what their current advisors or how clients have their current portfolios, the current appropriate amount of risk would be right now about 40%, because on average, the people listening right now, if we go through another 08 financial crisis, they could lose on average 40%. We see it as low as 25% and as high as 60%, but the average is right about 40%. So we go against the grain because do we believe someone in retirement or getting ready to retire should be anywhere close to that 40% average risk?
Absolutely not. 100% not. And we say 40% risk. I'll give you an example. If you have a 60% equity portfolio, whether they're stocks or stock funds, and 40% bonds or bond funds, you have approximately a 40% risk factor, right? And that's a typical portfolio configuration that most people have right now if they're in their late 50s to mid 70s. You have a 60-40 portfolio. And you are going to lose money when the market goes down. We can't, it's inevitable. You cannot stop that from happening. And you will have major losses at times, and you will have major stress. And we do not believe that level of risk factor is appropriate for a person that's retired or getting very close to retired, because we know the data, we know the math. We know there's a high likelihood of you running out of money with that type of portfolio if you just try to stay the course and you kind of just wing through it and hope it all works out. And what happens is when you are retired, your psychological system is different in that when you weren't retired and were working and had a paycheck, you could lose 30 or 40% of your money and you were able to write it out, but you weren't using your assets for income. and you had a job and a paycheck. But when you are retired and you're using your assets for income, your assets are your paycheck. And when you start to lose 20, 30, or 40% of the value, it's impactful. And often people make terrible decisions at that point. They move out of the market when they shouldn't move out of the market and make terrible decisions that can ruin their retirement. So you can position yourself today whereby that doesn't happen. You can position yourself today where you have a guaranteed income stream that will last the rest of your life. You can still be in the market, but you won't have a 40% loss. In that same scenario, our job is to try to get your loss factor less than 10%, ideally around 5%. We can't get rid of risk in the market, but we can deploy your assets in different financial instruments to lower your risk.
Well, the question is, what is the appropriate amount of risk for a retiree or pre-retiree? And you said it there towards the end, and that is probably 5%. Not based on what you and I say, Jim, but based on what our clients and hundreds, even thousands of retirees have told us how much risk they really are willing to take if it's their choice. The clients always think the advisor gets to determine the risk. And up to this point, that's what's happened. And that's why you're so worried about losing so much money, because you have in the past. But what if the truth of the matter is, which it is, you get to control how much risk you want in your portfolio based on how much you're willing to lose? That is the only way people can start to feel like a big, huge stock market loss isn't going to crush them. So let's say we go through our risk analysis and we have a very simple form to figure out how much risk you want. And you're like 95% of our clients, and you say you don't want to lose more than 5% of your total assets, even if the stock market crashes 50%. We don't know why people gravitate towards that, other than I think everyone can understand that a 5% loss isn't huge, and we probably can recover from a 5% loss. A 50% loss is huge, and we probably won't recover. So we can get the risk down to 5%. It helps people to stop worrying about their money so much. And we're able to do that for 95% of our clients if we use our 3 buckets. And our 3 buckets include putting some money in liquid cash that has no risk, putting some money in the stock market, but instead of having full 50% stock market risk, we want to reduce that risk using stop losses and using monthly rebalancing of the portfolio. So that will have some risk. And then using the green bucket, which is the principal protection guaranteed lifetime income bucket, the annuity bucket, which has no stock market risk. If we combine all 3 of those assets, Jim, we can get down to a 5% or lower risk factor for 95% of our clients. And then, do they worry about their money as much now that some of the money's protected 100% against stock market losses, and some of the money is guaranteed to pay them income for as long as they live? How much do they worry now once you just do that first little step?
People have to understand that risk is a major component of retirement planning, and it can either derail your retirement plan or it can help you based on how much risk you have. And our goal is to get that risk factor less than 10%, ideally around 5%, so that the market drops by 50%. You don't lose 50%. You might lose 5, 6, 7, 8, or 9%, maybe 3%, but we have to deploy the money into different financial instruments. We cannot put all the money in the market. We have to design a plan based on what you're trying to achieve for income and growth and liquidity, and we can do that with our planning process here, Dan.
No, exactly. And if you have a $250,000 pension and you have $2 million saved, you probably don't need a lot of other income coming from that. You probably don't really got to worry about losses. You really don't need us.
No.
But if you don't have those big pensions, which most people don't, you need to put together a plan that will battle high risk and will provide high income. You're back with Dan Ahmad and Jim Files, the Peak Financial Freedom Hour. And the topic today is going against the grain. It's titled that because Jim and I in Peak Financial, we don't give the same advice as the majority of financial firms that are out there. The majority of the people that are giving you advice on the radio, we do things differently because we only work with retirees and soon to be retirees. Most of the other advisors out there will work with people that are accumulating assets for retirement. That is not our market. Those are not our clients. And for those people, you can be more aggressive. You can take the risk. You can have tremendous volatility. You don't need the assets for income yet. And it's okay if we're going for the highest return because we have time on the side. Our clients are completely different. They're the retired or getting ready to retire in the next 5 years. They know the one thing that would stop them from a successful retirement is a huge loss. They just know it intuitively. It's simple, black and white. So that's one of the first things we do is help them reduce their risk, as we just talked about, Jim, down to 5% or lower for 95% of our clients, meaning if the stock market crashes 50%, our clients would be projected in writing to lose 5% or less. So that kind of goes hand in hand with the second thing that we go against the grain, in that Most people out there have been told, whether it's by their advisor, by the internet, by their 401k, by their brother, to hang in there, write it out. You're in it for the long run. Don't worry. The market will always recover. Doesn't matter how much you lose, hang in there. And that is the proper advice if you are in stage one of retirement planning, asset accumulation, and you're young because you have time on your side. We will never, ever tell a client to hang in there and write it out, regardless of how volatile the stock market goes up and down. Our money management platform that we use will use stop losses. Every month, we're going to go and rebalance the portfolio because we have to look at things on a short-term basis for clients because we don't have the long-term to recover if they do suffer a 30 or 40 or 50% loss.
And what that means by recovery is if you're 30 years old and you live until 85, you have a long time to recover, right? You have 55 years to recover. If you're 65 years old and you live till 85, you have 20 years of recovery and you're using your assets for income. So the impact when you're retired, when the market goes down is tremendously different than the impact if the market goes down when you're working, right? Because you're not dragging money out of your portfolio in the form of income when you're working because you have a paycheck. Now, two things happen in retirement. If the market goes down and you're losing money when the markets go down and you're also taking money out in the form of income, it's kind of like a double whammy, right? You've lost money because the market went down. You took money out to live on and you took money out when the market was going down. You don't have that same money to recover when the market goes up. So it gets really complicated. And that is why an income plan, a tax plan, a legacy plan, a risk plan, a fee plan, all that stuff is, we believe, mandatory when you're getting close to retirement or in retirement. You did not need that when you weren't retired, right? As you mentioned, Dan, you could be aggressive, stay the course, dollar cost average in every 2 weeks with your 401k plan. And you're going to likely be okay over time because you have time on your side, but you don't have time on your side when you're getting close to retirement age or you're in retirement.
Well, Jim's saying that because we want you to remember what it felt like back in 2000 with the technology bubble. Stock market, the S&P went down about 53.4%. The NASDAQ went down. Technology went down about 75%. But let's just say you lost 50% back then in your 401k or IRAs or brokerage, which you might have and probably did. You needed a 100% gain just to get back to even. And that's assuming not paying any fees or taking any income out. And let's say it took 5 years for that to recover. Okay, you finally recovered, but then the entire loss and recovery time, you were at a flat, no gain mode. What if you're in retirement and you go back to 2008 and the stock market goes down 53.1%? So let's say it went down 50%, but you're also taking 5% income out and you're also paying fees. You probably needed about a 150% gain over the next 5 years just to get back to even. What's the chance you're going to get a 150% gain on a guaranteed basis over the next 5 years? And it's so low. So you can't get into that mode that you're forcing yourself to get these huge gains by hanging in there and write it out. You can't hang in there and write it out. Otherwise, all you're doing is giving yourself a lower chance of success in retirement.
You know, if you look at where the market is today, if you look at the S&P 500, about 60% of the return in 2024 were from about 11 different tech stocks, right? So if you own technology in 2024, you made money. If you didn't own technology, you probably made very little money or you could have lost money. So do you think the tech market is overvalued? By all technical analytics, the tech market is overvalued. Go back to 2000. The NASDAQ was overvalued, right? It was tech driven. The NASDAQ dropped 78%, which means if you had $1 million, you lost $778,000 on paper. You were down to $231,000. It took 19 years to recover from that loss, 19 years. So do you see any type of mirroring right now between what happened in 2000 and what potentially could happen in 2025?
Well, right now it's close to the same because look at what drove the market back then.
Yeah.
Like you're talking about, it's technology. What's driven the market now? Technology.
Exactly.
The market was double overvalued versus price earnings per share. So it looks almost flipping identical.
Almost identical, right? People say, well, it's artificial intelligence. That's right, but it's ramped up in the last 18 months. It doesn't mean it will continue to do so. It doesn't mean we don't believe you should have money in the market. We do believe you should have money in the market, but you better be careful because these things happen. They happen unexpectedly, and people lose massive amounts of money at the wrong time of life. And if you're 60, you cannot recover from a massive loss, Dan. It'd be almost impossible.
Well, think about what you just talked about. The market goes down 78% and you're in retirement, and that happens to you, which we've seen people come in, telling us before they become our client what's happened in their lives. And they've gone through the 2000 technology bubble. They lost 50% or more. They recovered by 2008. They went through the 2008 financial crisis. They lost 50%. Then they recovered by like 2018 or 19.
Yeah.
And now they've gone through volatility the last few years. And like, what in the heck do I need to do to stop doing this? Well, you have to stop doing the same thing you did over that entire time period, because you're not going to get any different results. You have to now think, in retirement or getting close to retirement, what are my goals? Number one, not to suffer a large principal loss, because if you do, your plan is not going to work, and to create a written plan that shows you where your income is going to come from and generate a high percentage of that income on a guaranteed, dependable basis that'll never run out, no matter how long you live and no matter what the stock market does. It's the only thing that will help you feel comfortable that things are going to work out during retirement. It's the only thing that'll make you stop worrying about your money. You're back with Dan and Jim, the Peak Financial Freedom Hour. Today, we're talking about going against the grain. And that doesn't mean you going against the grain. It means Jim and I going against the grain, because we look at planning for your retirement differently than most of the other advisors, most of the other people that are on the radio right now. We look at you being in retirement, or within 5 years of retirement, being in stage 2 of retirement, which is called asset preservation and income distribution, not stage 1, which is asset accumulation. And there's some great advisors out there that'll help you accumulate assets. They'll design a portfolio for you. It'll have significant growth opportunity, but along with that comes significant risk, which you cannot do when you're in retirement, and you should not be doing if you're within 5 years of retirement. So there's two things we're going to talk about in this last segment of the show, and that is the use of certain annuities to fully protect assets against stock market losses and to create a high level of income guaranteed for as long as you live. Is that something retirees should consider? And the other thing then that ties in together with that is, should you have a written plan, or should you just rely on an advisor saying, oh, don't worry, I promise everything's okay? Well, these two things kind of go together, because you should never, ever invest your money, whether it's in the gold bucket, the bank, whether it's in the stock market, the red bucket, or the green bucket, the annuity bucket, unless you have a plan that specifically states and points out exactly how your money should be allocated. More importantly, how each one of those buckets is going to be used to create income and to create that successful retirement plan. Because a written plan now will tell you exactly how much money, and will calculate out how much money you should have in each bucket. And isn't that what you want to know? How should I allocate my money right now when I'm retired or getting ready to retire to give me the highest probability of success in retirement? Well, a written plan will do that. It'll calculate out how much in the gold bucket, how much in the green bucket, and the red bucket. Well, you should never, ever invest money in any of the buckets unless it's in writing. Most importantly, you should never, ever buy an annuity from anyone unless it's included as part of a written plan that shows exactly how much money is going into the annuity, what are the fees, how much income is guaranteed out of the annuity at what time, and that income is going to last for as long as you live at a very, very, very high payout rate. For example, right now, when we do planning, we're dealing with retirees and soon to be retirees. And let's say we put a plan together that allocates assets in the 3 buckets. Well, let's say we have some money in the green bucket. Because of current rates, payout rates being so high, we'll defer income from that for maybe 5 years. Would you be willing to defer income off of one of your assets for 5 years if you'd get a guaranteed 10% payout of your original investment for as long as you lived, even if you live past 100? And then we use some of the other assets first. So in that case, if the green bucket can protect assets against 100% stock market losses and give us those types of high payouts, should then retirees consider using that as part of their plan?
Well, yeah, I don't think, should you use an annuity? Should you use a financial instrument that does those things? It just happens to be called an annuity, right? But there's a number of different types of annuities. We're talking about a very specific annuity here called a fixed indexed annuity with an income rider. That's the only annuity we'll use in an income plan. And annuities can be confusing because there's a lot of annuities, and everything you heard bad about annuities is true. What you have to understand is there are advantages and disadvantages of every single financial instrument out there. Our job is to explain to you the advantages and the disadvantages. But getting back to the question, should you find a product or a financial instrument that guarantees you that no matter how long you live, and if you're married, no matter how long you both live, that income will be paid for you as long as you live? Should you find a product whereby even if you ran out of money, will that money still be paid to you? In this example, yes, it will continue to have your income stream delivered to you for as long as you live. The ability to make money. Yes, you're going to give away some of the potential growth with these types of annuities in relationship to maybe the S&P 500, but you have no risk. So it's a trade-off. So you have to be comfortable with trading off some of the growth for having guaranteed income. And you still will have growth based on historical data points, but you're going to give away some of the growth. But if the market goes down, you're 100% protected from any market risk. If interest rates change, you're 100% protected against interest rate changes. And your income can never go down. It can either stay level or possibly it can go up. So if you're looking for that type of instrument, that's what a fixed indexed annuity does with an income rider.
Everyone's looking for ways to protect their assets against large losses or eliminate them and get income guaranteed for as long as they live. But they get hung up on two things because of what's being taught on the internet or by other radio shows right now. And the two things are liquidity. They say, oh gosh, if you put your money in here, they're completely liquid. You never touch it again. That's completely false with the type of plans we use. 100% of whatever you put in minus whatever the premature withdrawal penalty, just like a CD, is available even if they want to take it out in the next month or a year from now or 2 years from now. They're told, oh, it's not liquid. You can't take income off of it right away. You can take income off of some of these plans within 30 days of deposit. So that's not true either. So liquidity for either lump sum or income, we can show people exactly that they don't have to worry about that. Then the other thing they're told, oh, if you put your money into these types of plans, the insurance company keeps your money. None of the plans we work with are going to allow the insurance company to keep any money in there when you die. 100% of the money in the accounts in a fixed index annuity with an income rider, whatever's left when you die, is passed 100% on to your beneficiaries. So what if now we can actually get all these things tied into one package? Then is this something people should consider as part of the plan? And the answer is yes, if you're retired or soon to be retired. Not that you for sure should have it in your plan, but you have to consider it. You have to look at it and you have to see how it'll fit.
But Dan, the beauty about this is that it's not all of your money. Remember, we have three buckets. We have a yellow bucket, cash. We have a red bucket, money in the market. We have a green bucket, the guaranteed bucket. This is just one bucket. And the planning process will determine how much money you should deposit in each one of those buckets, how much money you need in cash, how much growth do you want, and how much risk you're willing to take. That money goes into the red bucket. And the green bucket, which is the guaranteed bucket, how much income do you need, how much money you want protected in that bucket will determine how to allocate these assets. So it's really just putting together the math and making sure you're comfortable with the math. You get to determine in the end, once you're fully educated on how this works, how much money you want to put in each one of these three buckets. But this is true diversification because each one of those buckets behaves differently. The cash behaves one way, right? It won't go down if the market goes down. You'll have lower interest rates in the future. You could run out of money. The growth bucket will give you growth, but you have risk. You could lose your money. You could lose all your money theoretically. If you're pulling money out of the growth bucket, it can go down in value. The green bucket has disadvantages and advantages as well. The advantage is you'll have money for the rest of your life, no matter how long you live. The disadvantage, you might not make as much money in the growth bucket, but it's not designed for that. So they all have advantages and disadvantages.
For more information about Peak Financial Freedom Group or to schedule a consultation, just go to our website, peakfin.com. That's peakfin.com. And thanks for watching.